G'day there, Wealth Press subscribers, viewers, traders, and investors. Welcome to the midweek update. It's Adam Sarhan joining me today. Adam, how are you?
Excellent, James. How are you?
I'm doing really well, Adam. Adam, let's start with the elephant in the room. The storming of Capitol Hill yesterday seemed to have absolutely zero impact on markets. And from that sort of starting point, what is the opportunity? What's the market doing in reaction to this event?
Yeah, you know, James, one of my favorite sayings on Wall Street, it's not the news that matters, but how the market reacts to the news. That being said, the reaction remains extremely bullish. So if you peel back the onion a little bit and dive deeper and ask yourself why, it's clearly that the other elephant in the room is the Fed and all of the easy money that's expected to continue to come from global governments and central banks. And for now, pardon the pun here, but that trumps everything else. So as long as the market continues reacting well to all the easy money that's being injected into the system, almost all news, I mean, to an extent of yesterday, what happened doesn't even matter anymore because all weakness is being bought up. We're seeing a big rotation happening within the market. Leadership, the stay-at-home stocks are pulling back a little bit. A lot of the growth stocks are pulling back. Meanwhile, we're seeing a lot of that money rotate into undervalued areas of the market, which are the back to normal stocks. And as long as that rotation happens, we're going to see the major indices continue to move up.
Sure. The bigger news to me this week was the fact that the Democrats unexpectedly won the 2 seats up for grabs in Georgia, giving the Democrats relative complete control of all 3 branches of government, which, again, the market didn't seem to have any particular reaction to, except, of course, cannabis and psychedelic stocks spiked to new highs.
Right.
So what's our takeaway? What are the implications of a blue Senate, Congress, House, and executive branch?
Yeah, so I would say that there's a few takeaways for me. Number one, we'd expect an infrastructure plan, more spending to come. I mean, look, the market, if you look objectively, put any political biases you have on the side for 1 second, and you just look at the facts, the market's been up during both, Republican and Democratic presidencies, and during times where they've controlled both either side, it's all red or it's all blue, or where there's a mixed bag. The good news for us as investors and traders is that our job is to filter out all that noise and focus on opportunities to make money. And the market has showed us over the last 100+ years, there's a plethora of those opportunities. That being said, you want to pay attention to what's happening in D.C. because policy shifts and policy really matters. So let's look at the big things. Number one, you've got easy money from the Fed. Will that continue under the Democrats? The answer is yes, most likely. Number two, you've got spending, inflationary type policies are going to come, whether it's infrastructure spending or it's more jobs, whatever the case may be. But Democrats are notorious for spending a lot of money to help stimulate the economy. That's not a judgment statement. It's just a fact. Mm-hmm. And okay, that being said, that tends to stimulate the market as well. It also stimulates Main Street, which by definition, or by extension rather, stimulates Wall Street. So you've got a lot of money being expected to being flooded into the system from not just the Federal Reserve, but also from just fiscal, the government. You can have infrastructure plans, you can have job plans, so on, and other programs, so on and so forth. Then you have the $2,000 checks, which are expected to come out. And that's now largely expected to pass, which should give the consumers a lot more money. And consumers make up 2/3 of the economy. So that should be bullish as well. So when you put all these things together, it really paints a bullish picture for the stock market, notwithstanding, several pullbacks along the way.
Sure. Yeah, that's interesting. I shared that sentiment pretty much with my audience yesterday that 2021, at least in the early part of it, is looking like one of the most unprecedentedly bullish environments that we have ever seen. I mean, with so many clear subsectors on the bull front, like these SPACs that have $1 billion shopping for new businesses. You've got the cannabis and the psychedelic sector. You've got technology, which is obviously going to be the primary beneficiary of the stimulus packages. And then this $2,000 checks. Now, with the government taking control of the Senate as well as the House, that makes that whole thing a fait accompli, in my opinion. Is that shared with you?
More or less, you expect it to happen at this point in time, but you also have other areas too that are working. You've got the solar / alternative energy. There's a big push by the Democrats to move into the green energy type things. So those names tend to rally under Democratic leadership. You also have small caps that tend to do well. The financials, James, have been really buried for a long time. They're expected to come back to life. You've had the yield on the 10-year go above 1%. Bonds went down, yields went up. That tends to be constructive for financials. As we get back to a normal, the economy is expected to grow. When you have economic growth, that money is being moved into the system, and the financial stocks tend to benefit from all of that excess money being moved around the economy. And that bodes well for the financials as well. And then, of course, you've got the travel stocks and a lot of the commodity stocks, which haven't really participated in much of the rally we've seen since the March low almost a year ago. And they're coming back to life now. That's all normal.
Sure.
Yep.
Gold as an example is, if checks go out for $2,000, that implies the $900 billion package just became somewhere just shy or just over $3 trillion. And so the last time that happened in March, that was when gold set its all-time record.
It began the move, exactly. So you're in a situation now where we're expecting inflation to kick in. Now, that doesn't mean it's going to happen. We've been expecting it for a long time, but it's important to understand spending happen. The government loves to spend money and spend your money, my money, all the taxpayers' money, whatever government it is. I mean, that's their job, is literally to spend our money. So under Republican leadership, the right, left, every center, it doesn't make a difference. Tremendous amount, gobs and gobs of money are going to be spent. Now, where that money's spent, number one, and number two, how that money is spent, what areas in the economy, that's really what matters for you and I and everybody else listening, and how we can participate and make money from all that. So if we're expecting inflation to creep higher, which, by the way, the Fed has made it very clear they want inflation closer to 2%, they're going out of their way to make sure inflation goes up. One of the best trades you could take here for the next 12 to 18 months here would be long inflation. And like to your point, a good hedge against inflation historically has been gold. So, gold and other assets that tend to benefit from that kind of environment do very well.
Sure. So with the Democrats in sort of unified power position in the U.S., that really gives the entire developed world's central banking system a permissive environment to mimic completely what the U.S. does. And, we know that Kamala Harris and Joe Biden are very dovish when it comes to the whole idea of fiscal stimulus and monetary stimulus.
Right.
And, that has its implications surrounding inflation. But, I mean, that's why I thought that this is really going to catalyze the biggest bull market we have, the biggest phase of this never-ending bull market since 2011. It's going to be a unified, concerted, dovish monetary and fiscal stimulus environment, which means, it's just, I hate to use the term unprecedented because it's an unprecedented amount that I've used that term, and it's become very cliche. But so my question for you is this: is there greater opportunities outside of North American markets in view of this, where they've been more capital starved, like, for example, in Europe and Southeast Asia?
Yeah, I think that's a really good point. So we are in unprecedented markets. To your point, it's not just since 2011. I go back to March of 2009 and just say the money train has just been print. And when you're done, print some more. And the reality is, James, this is a big global experiment that's never happened before, and nobody knows how it's going to end. So if you turn back the clock, anybody listening that remembers 1999, or the late 90s for that matter, after the August of 98 into March of 2000, you had this environment where people threw logic out the window. Anything with a .com, they bought it. No sales, no earnings, they'd buy. So to your earlier point about these SPACs that have no sales, no revenue, same thing with these speculative biotech names and genome stocks and so on and so forth. No sales, no revenue, but they're going up 3, 4, 5, 10-fold in price in weeks at a time. Logic is being thrown out the window. So as a logical investor, people like you and I that have been around the block a few times and seen cycles, bull markets, climax runs, bubbles, the tops of bubbles, and then busts, it's important to understand that everything happens in cycles. So right now, if you're a value investor and you're looking for undervalued areas of the market, you can look outside North America. US and Canada have had a huge move in the last several years, if not longer. And other areas of the market are now playing catch up, or other areas of the global economy are playing catch up. I'm always a fan of buying strength and buying the best of breed, because there's so many stocks out there, right? So if we can filter out the noise and focus on the strongest of the strong, you'll do very, very well over time. But that being said, there are a tremendous amount of opportunities if you can go out and find them. You had mentioned gold earlier. I also like gold. There's a lot of gold miners that derive most of their income from overseas. That would be a good two-pronged approach, because you're killing two birds with one stone, if you will. You're making money on gold if gold goes up. You're also making money from the fact that they're located, or their mines are primarily outside of North America. So something like that, where there's a multiple pronged of reasons of buying, opposed to, hey, I just want to buy something outside of North America. To me, that would be a much better approach. But I'm always a fan of finding value, finding growth, and wherever that growth is, stocks usually will follow with higher prices.
You bet. Which brings me to the question of China. China, I think it was rather sort of symptomatic that the plan to delist three of the largest Chinese tech companies on the NYSE was suddenly dialed back quietly, and very, very, sort of consistent with the policies of the Democratic government, is that this whole, dialed up, contrived trade war with China, which Trump clearly did in an effort to bolster the appearance of his pro-American stance,
right,
is now, that's not a gimmick or a device that the Democrats, that's just not something that they need. So does this mean that we should maybe be looking at, Chinese companies have their own problems. The Chinese government, basically dismantling Jack Ma's empire in full public view, and Jack Ma himself being out of sight for the last 3 weeks is, that's an internal problem. But that gives us a chance now to look at China and think that, okay, Chinese stocks are now going to be welcome back in American markets, and probably they've been beaten up as people anticipate that they're going to get kicked out of the market. So is there a short-term opportunity for Chinese stocks in America?
Yeah, James, you touch on really, really, really good points. So a few things here. Number one, you look at Jack Ma, the founder of Alibaba. His stock, ticker symbol is BABA, for those of you that are following at home, has lost a third of its value, or it's down $100 since the end of October. So in the last 3 months, the stock is it went from 319 down to 220. So about $100 in value. A third of its value. And just like that, you're dealing with a communist country, number one. Number two, you're dealing with a president that's pretty much there for life, right? So he looks at Trump in the 4 years of whatever's happening in the trade war and blah, blah, blah. There's a lot of different theories as to COVID and where it came from, and whether it was a shot, a military shot, a biological weapon, a deliberate one, not deliberate one, all these speculations about what's the real intention behind it. But the fact is China is one of the fastest growing economies in the world. It's all noise. Look at the facts. GDP in China is one of the fastest growing in the world, number one. Number two, it's on pace to become the largest economy in the world within the next, I think, decade or so, if not a little bit longer, depending on the growth rates, all that fun stuff. But it is a massive, massive superpower, and its power is going to continue to grow. So George Soros's partner, Jim Rogers, former partner that is, told me one time, he gave me a great line, James. He goes, if you study history, societies and civilizations and so on and so forth throughout time, power follows wealth. So if you study where, how civilizations grew and then subsequently bust and they went back down again, sure, there's sometimes where there's military conquest, they're conquered from a military standpoint. Sometimes they just fall from within, so on and so forth. But he looks at it, he's like, listen, just look at the money. Again, follow the money. Why do people rob banks? That's where the money is, right? So if you look at where the money is now and where the money's flowing, you can see a massive amount of change happening in real time. So, are Chinese stocks good place to go? It depends on the stock, obviously. But, will you see growth there over the next 3 to 5 years? Most likely you probably will. That being said, you also have a tremendous amount, and this is just a big question mark, of political risk, which could take a stock like Alibaba down by 33% in 3 months just because.
Right. Right.
So ultimately the question becomes is what do you want to, where do you want your money to be? And are you open to taking that kind of political risk? Because you can have all the growth in the world. The stock is down 33% in 3 months. It doesn't matter. The growth doesn't matter at that point.
Sure. Adam, those are fantastic points. Let's conclude our conversation. If you could pick one stock to sit with on a desert island and watch a chart for the next 3 weeks, which stock would that be?
Oh, 3 weeks?
Yeah.
Oh, okay. I thought you were going to say longer. For 3 weeks, I would say it's a longer term play, but for the next 3 weeks, I'd say Spotify. Take a look at SPOT. It's a stock that's acting very, very well. They're in the music business. The one thing that's evergreen is music. People love music. It doesn't matter what your race is, your nationality, your socioeconomic level, your education. It doesn't matter. People love music, and Spotify is a modern way of allowing people to listen to music uninterrupted, and blah blah blah. They're also big in podcasts, et cetera, et cetera. So that's one stock that should do well over the next, for the near future.
Sure, I'm a subscriber to Spotify, and I listen to it daily. So I'm surprised to hear it as a stock recommendation. I'm also surprised at myself for why didn't I think of that? I use this thing every day, and it's like great. Okay, Adam, well, let's leave it there for now. I appreciate your contribution today. As usual, I'll look forward to speaking with you throughout this wonderful, crazy year. Have a fantastic weekend.
Thanks, James. You too.